Greetings from the FxPrimus webinar, the safest place to trade. We want to provide all of our clients with the knowledge they need to trade profitably. Enjoy.
Alright, so good evening. So I think everything is fine. You should be able to see my screen and the audio, just to double check. Yeah, it should be working. Alright. Okay, so yeah, as mentioned, today we'll be sharing with you a particular strategy in terms of what we call a structured trend trading. So this particular strategy is very heavily reliant, of course, on technical analysis. And the beauty of it is it's very objective in its approach, okay? Which means there's actually no, you don't need to kind of like second guess, there's no discretionary element to it. And it's actually designed, very fitted for, I would say, from beginner traders who just got into trading. This particular strategy is very effective for them. And this is one of the strategies that I personally use when I kind of like in my early days of trading, okay, and I did see quite a pretty nice little success result from it as well. Okay, of course, it's not gonna give you like 90% hit rate, 100% hit rate. The accuracy range, from back then I used is about 55 to about 60% accuracy. But the beauty of this strategy is going to be the risk to reward ratio. Okay, and with just about 55% to 60% hit rate, the R, which is the return of it, can be very, very interesting. Okay, because the risk reward ratio we're looking at is always like 1:2, 1:3, or even potentially bigger than that. Okay, so what we're going to cover in today's session over here, okay, is first is to how to define a trend confidently, right? And this is something that I think no matter whether you're new or experienced in trading, determining the direction is always very important, right? The first thing you look at the chart, you need to know first, do you want to be focusing on buying, or do you want to be focusing on selling, or is the direction not clear? Okay, and you probably want to just avoid that particular instrument. Okay? Now, there are many ways in which you can define what we call a directional bias, okay? But today we're going to present and share with you a technique that is very objective, right? There's no second guessing. And then after that, I'll share with you how we can then, step by step, establish a high probability trade, okay? In terms of whether are we looking at buy or whether looking at sell, where are we going to get involved in it, where's our stops, where is our target, etc. Okay? So today's kind of like objective over here is to really give you a complete strategy in which you can trade in line with the trend. Okay, so what is a trend, right? So we'll dive straight in. What I'll do over here is I will share with you in terms of the presentation over here, and then we'll jump into the live market to talk about some opportunities that we have, in the near term, and of course applying this technique into the market so that we can actually see the practical aspect of it. Okay, so what is a trend, right? Of course, if today you're a little bit more experienced in technical analysis, you would have your own way and you would understand, how to identify a trend. But for the benefit for everyone, perhaps someone who is very new to trading, okay, let's just quickly define what is a trend. Okay, a trend is in general a particular direction the market is moving towards. Okay, so in terms of trading, right, it can be an uptrend, which means the price is going up in the general sense of things. It can be also in the downtrend, which means that the market is generally coming down. And what we have is also a sideways trend, right, which sometimes you might heard the word, it's range bound, it's ranging, right? Basically means the market doesn't really give us a very clear sense of direction. Now, this strategy that we're going to cover today, we need the market to be trending in a particular direction before we execute it. Okay? So if today we identify that the market is in fact in a range, okay, then you wouldn't want to actually trade it. Okay, you want to ensure that the market is actually in a trend, whether is it up or down, before you can execute this. Okay? So very quickly, if today you just based on a visual perspective of defining a trend, sometimes it can be quite clear, right? In an example like this, we can all say that this is an uptrend because the market is in fact going up, very clear. Okay, and then this is definitely a downtrend, right? Very clear, the market is basically coming down. Okay? Now sometimes it's easy because it's very obvious. Okay, but if today you don't have any experience in identifying all this, you might start to question and say, how do we know exactly it's up or down? Okay, and that's where today's sharing comes in, to give you a very objective way of defining it. Okay, so this is what we call a sideways trend, right? Of course, right now you can see the difference, right? Because I can't pick the obvious differences in the market, whether up, down, or sideways. Okay, but sometimes when you open a chart, look at this. How would you define it, right? It kind of like, it gives you a sense of range, and then previously it gives you a sense that it seems like it's coming down, but then right now it seems like it's going up. Okay, so the market is never going to be perfect, and there will be instances where you can't have a bit of doubt. Okay, and that's where the objective method of defining a trend comes in. Okay, even something like that, right? Will you define it as an uptrend or downtrend or a sideways trend? Okay, so this is the part where to help you be clear and to have that confidence in identifying whether you want to focus on buy, sell, or not even touching it, you need to have a very clear way of defining a trend. Okay, so for us, defining a trend basically requires 4 points. Okay, 4 points on the chart. Okay, and this one here, of course, if you have some experience, you've heard of this term before. It's called higher high, higher low, lower high, lower low, right? So in short, we call it HHHL, which stands for higher high, higher low, or lower high, lower low, right? LHLL. Okay, so this is basically the 4 points that we mentioned. Okay, so how are we looking at, the high high, higher low, or lower high, lower low? Okay, so the key word on this here is the word and. Okay, so what we need is not just a higher high or a higher low, right? We need both a higher high and a higher low. Okay, these two things need to happen before we say that, okay, the market is in an uptrend. Okay, so the keyword is and, right? The keyword is and. If it's a downtrend, then of course it's a lower low and lower high and lower low. Okay, so in a while I'm going to show you some examples or illustrations so that you know what we mean on this. So this is obviously an uptrend, right? But if today want to fit in the definition of a higher high and higher low, how do we look at it? Right? So we start off with the first point, which is the initial starting point. That's our initial low, right? And then the market went up, we have a high, the market kind of peaks, and then it starts to come back down. Now, as it comes down, it doesn't really break the previous low, right, which is 0.1. So what it does over here, it forms a higher low, right, because the market then after that starts to go higher. Okay. So at this point in time, what we have is we have a low point, we have a high point, and we have a higher low point. But at this moment, right, if we do not have this peak on the right, then we don't have a high high, right? So we can't say it's an uptrend until the market gives us this fourth point, which is a high high. Right? So for us to clearly define that the market is in an uptrend, we need a minimum 4 point, right? So only when we have this can we say, okay, the market right now is an uptrend, okay? Because we have a higher high plus a higher low, right? These two needs to be there. So the minimum points to define a trend is 4 points, right? And we need this high high, high low. Now, if it's a downtrend, then it's basically the opposite. Okay, so basically we have a high point, which is our initial point, we have a low point, and then we have a lower high and we have a lower low. Okay, same thing here, we need 4 points in order for us to establish a downtrend. Now, if today we look at the chart and we can't have high and lows, right? But we don't really have a lower low, lower high, or we don't have a high high and a higher low, right? So basically what we have is low points, high points, low points, high points. Okay, but we have a higher low, but we don't have a high high, right? So technically, we define this as a sideways because we don't have the word and, right? We have a high low, but we don't have a higher high, right? So we can't say it's an uptrend, we can't say it's a downtrend, right? So that's how we very quickly define whether the market is an up, down, or sideways trend. Okay, so just based on this, right, what you can do is you can open up a chart, any chart you can look into, any particular time frame you can look into as well, right? So in this case here, if I'm going to use maybe an hourly chart, okay, and this is a chart of dollar index, right? It can be anything, it can be any time frame. So on the hourly chart, okay, what we have if we focus on this particular scale, okay, is that we have this peak, okay, we have this low, we have this peak again, but this peak you realize that is actually lower than the previous high. And then we have this low here, which is lower than the previous low. Okay. So technically from this perspective here, we have a high, we have a low, we have a lower high, and we have a lower low, right? So in this case, what we have is actually a start of a downtrend in this perspective, in this scale. Okay. What we can then of course do is we can also look into higher time frames, right? So for example, if I give you an example of a daily chart, okay. So if on the daily chart and you start to look at it from this perspective, okay, we have this low, we have this high, we have this low, which kind of came back to where it is, and then we have this higher low. We have this lower high. Okay, so I'll put here LH. This is a high. So in this perspective, we do not have a trend, okay? Because number one, we don't have a higher high, higher low. Number two, we don't have a lower low, lower high, right? So then our definition on the dollar index on this chart in terms of a daily scale is a sideways environment. Okay. You can apply this technique to other instruments as well, right? It doesn't need to be in FX, right? It can be in terms of gold. Okay. Same thing over here if you look into maybe on the hourly chart. Okay. So in terms of hourly chart, what you see here is you need 4 points, right? So always start off with the most recent chart, right, on the right hand side. So you realize that, okay, the market is here, so we have this low point, we have this high point, we have this low point, and then we also have this high point, right? So we need 4 points. We always need 4 points. So this is the 4 points, right? 1, 2, 3, 4. And then you ask yourself, do we have a high, 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 low, or do we have a low, low, lower, high? Now in this case, what we have is this is a high point, this is a low point, and we basically don't have a high, high, don't have a lower, low. Right? So this is basically defined as a range environment for gold in a 1 hour chart perspective. Okay, can follow me, right? Now, suppose today you decide to go down maybe on the lower time frame. Okay, maybe I'll pick 5 minutes so that things can be somewhere clearer, and then we can illustrate on that, right? So same thing here, right? If today you look at this, okay, price is currently here, so maybe we have this low, this high, this low, right? We have another high here, and of course another low here. So in this case here, what we have is we have a higher high and a higher low. Okay, so you can see this is a low. You can even take this as a high, right? And then what we have is a higher low. Okay, we have a higher high. And then same thing, right here we have a higher low, higher high, higher low, right? So on this time frame, we are in an uptrend because we have a clear definition of higher high, higher low, and that's an uptrend. Okay. So of course, if today you look at different time frames, you might come into different conclusion of a particular instrument, whether it's in the trend, up, down, or sideways. Okay. So what you need to of course do is you don't want to play around with too many time frames. You want to of course fix a particular time frame that you want to work on. Okay. So that's the first thing that you need to be very clear, right? What is a trend? You need to be very comfortable and confident in defining that. Okay. Now, once you're able to do that, you kind of can pick a certain direction to focus. Of course, if the market is in an uptrend, you want to be focusing on buy opportunities. If the market is in a downtrend, you focus on sell opportunities. If the market is in the sideways, then you don't want to use this strategy, right? You may need to use another technique. So for today, we only focus on markets that are trending, right? Whether it's up or down. Now, the next step here is to start identifying and what we call establishing structure. Okay. So what exactly is structure, right? If you have heard of terms such as support and resistance, supply and demand, the principle behind those methods are quite similar. Okay, and for me, I just basically simplify it and we call it structure. Okay, structures are basically key areas on the chart that the market tends to give off some kind of reaction. Okay, so I refer to structure as whether is it going to be support or resistance. I just call it structure. Whether it's supply and demand, we call it structure as well. Okay, because the definition of it is quite straightforward. An area in which price tends to give off a reaction, we want to pay attention to that, and that's the area that we call structure. Okay. So using that 4-point system that we covered just now, right? To define a trend, we basically need 4 points. Okay. So once we have actually identified a significant high and lows, right, based on the 4-point system, what we then have here is we can use the highs and lows as our structure areas, okay? Which means that the market tends to react around those zones. Okay? So coming back to this here, you can see the low, the high low, and the high high. Each of these points become a structure level as well. Okay, so it becomes very straightforward and simple, right? Once you establish the point, those points naturally become a structure. Now, structure basically means that in the future, when the market comes back towards this area, we can always expect some form of a reaction. Okay, again, nothing is 100%, but high probability we're going to expect some kind of reaction. Okay, same thing over here as the market is coming down, right? High, low, high, lower high, and then lower low. Each of this point becomes a structure level as well. Okay, so structure here, the idea is we are expecting some kind of reaction. Okay, so which means that if today the market is an uptrend, okay, we want to wait for the market to come to a certain structure level and then look for opportunities to get involved in a buy. In opposite, if the market is in a downtrend, and then we want to wait for the market to come into a structure area and then we'll look for a sell opportunity. Okay. So this areas becomes key levels in which we can look for opportunities to get involved in. Okay, so very simple. When we're in uptrend, we obviously want to be buying it, right? If we're in the downtrend, we want to be selling it. If there's no trend, we ignore the structures because we don't want to be getting involved in a particular trade when there's no trend. Okay, so give you let's go back to the chart and give you some examples. Okay, we'll pick another instrument, right? Let's just say EuroCAD. Okay, I'm looking at it on a 4-hour chart. Okay, so this is more like looking at 4 hours is more of a swing trading environment, right? So it's not going to be a short-term thing, but maybe it's a slightly mid to long-term opportunity. Now, example, right? We always start off by establishing the 4 points. Now, if the market is here, basically we have a low right now. Okay, you always just go back, right? Move to the left. Ask yourself, how did the market comes down here, right? It came from here, this high. Okay, how did the market comes to this high? It came from here. How did the market came from here? You know, you can take this high or you can take this high. So with just this, right, what we have is 1 point, 2 point, 3 point, 4 point. Enough. Okay, we are currently in a downtrend because very clearly defined, we have a lower low and a lower high. Okay, so once we have the 4 points defined, what you can do is, of course, you can put in some horizontal lines on each of these significant areas to help you mark out what we call structure areas, right? Which means that in the future, if the market comes back, okay, to this zone or this zone, it tends to give you some kind of a reaction. Okay? It's not going to be 100% all the time, but it does, right? So if I just stretch back a little bit, right? Again, it's a concept of just the price tends to react, right? And look at this. In the past, the market bounced, the market bounced, the market bounced. It breaks through, it acts as a resistance here. And then it breaks, so in the future, if it comes back, there's a good chance it will tend to react off this area. And that's all what we are looking for. Okay? It's not going to be 100% reacting, but it has a good tendency of, it's going to give you some kind of reaction. Okay? And we call those structure areas. Okay? I'm going to pick another example over here, maybe pick a nice little trending one, right? So maybe Aussie Yen. Okay, the market is here. Okay, how does it come out? It came from this low. Okay, how does this low form? It came from this. How does this high form? It came from this low, right? So from this point here, we kind of have a little bit of a higher high, higher low. So it's what? Currently it's an uptrend, right? Based on this definition. So where are all our structure levels? This becomes a structure level, this becomes a structure level, this here as well, and of course, right now at the top. Okay. So if you stretch back a little bit, you can see, right, these are generally areas in which the market tends to react, right? Of course, this one here, if you stretch back a little, it's not picture perfect, but you can see how the market tends to react around that zone. Okay, this one here, if I stretch it back a little bit, you can see, the market tends to react around those zones as well, right? So of course, you don't need to really stretch all the way to the back, right? But what we just want to be clear of is that these are areas in which the market tends to have some kind of a reaction, whether it's bouncing off or what. Okay, so that's the idea of structures. Okay. So the steps here are quite straightforward, right? First, you define the trend. Second, you identify the structure, which is basically just looking at those significant high and low points, right? And then the third part over here that we're going to add on, step by step, is what we call a confluence. Now, the definition of confluence is basically the idea where there are more than one thing happening around the same area. Okay, so that's what we call confluence, right? And how we use this principle in this particular strategy is we're going to add in Fibonacci ratios. Okay? Now, if you're very, very new to Fibonacci ratios, they're basically, a way of measuring the market movement. Okay. Now, some traders often use the Fibonacci ratios as a standalone technique or strategy, but for me, I always suggest you don't want to just pull fibs and then design your strategy based on like, if the market comes back to a certain fib level, to just enter and buy, okay, or enter and sell. The success rate of that is not going to be very high. But if today you're going to add layers to it, right? So what we are doing here is we're not just looking at fib ratios, but we are using fib ratios to confluence with a structure, to confluence with a particular trend direction. That starts to increase the probability of you getting it right. Okay. So Fibonacci itself, if you're fairly new, right, you might be thinking that, is it going to be very complex, right? But if you're very new to fib, right, I always say think of it as a ruler, okay? And you're basically just pulling this ruler and then the calculation is being done for you, okay? So fib itself, okay, what we want to see in this particular strategy is we want to have a certain Fibonacci ratio coming close to our structure level. Okay, so the definition of close is, of course, we don't have a clear like 5 pip, 10 pip definition. But the idea is if you look at the chart, it shouldn't be too far off. Okay, later I'll show you some example and then you get an idea of it. Okay, so we want the fib to come close to our structure, and the fib ratios that we're using, okay, are quite selective. For me, I'm using mainly the 50 and the 618 for potential entry area. And then I'm using the 127 and 1618 for our target TP area. Okay, so these are all the ratios you need to know. Okay, so now how do we use this particular tool?
Thank you for viewing. To get the complete profitable strategy video, please use the link to sign up if you are not a FxPrimus client and fund at least $50 in USD. Please fund in a $50 USD deposit if you are a current customer. Please send admin, Nadia, the proof of funding after doing so. We want to thank you again for your support and for watching. Have a good day and trade safely.